The Australian Financial Review.
Yeah, so a few years ago now, I sold my house. I wasn't quite ready to buy another one, and I had a little bit of money to park somewhere, and a friend had told me about LaTrobe. I checked out their interest rate. It was really good compared to the banks. And because I only wanted to do it for about 12 months, I thought, why not?
That's our colleague Mandy Coulin, and thanks to investors like her, LaTrobe Financial and other private credit funds have been having a boom run. These funds have drawn in billions of dollars from small investors, including superannuation money, attracted by high interest rates.
Private credit markets have seen explosive growth over the course of recent years, and one of the leading players in Australia has been LaTrobe Financial.
These private credit funds sell products that sound like bank accounts and lend the money to businesses that banks won't lend to.
Everybody's getting involved. But it can't all be just rainbows and unicorns, right? That's the whole point of this.
Recently, two stories have exposed the other side of the boom. The corporate regulator announced a crackdown on private credit and singled out LaTrobe.
Some of these mortgages that are part of the assets under management aren't the sort of mortgages that banks would necessarily finance. Just over half of the mortgages in the 12-month account are rated as super prime or prime, but the other half are rated as below prime.
And while the regulator investigates, the Sydney pub baron Jon Adgemis faces bankruptcy after he racked up $1.8 billion in high-interest debt from private credit. Welcome to The Fin. I'm Fiona Buffini, in this week for Lisa Murray. Today, senior reporters Jonathan Shapiro and Primrose Riordan on what these two stories tell us about the private credit market, the risks for super investors, and whether the golden run is over. It's Thursday, October 2. Johnny, Primrose, thanks for coming on the podcast.
Thanks for having us, Fiona.
Yeah, thank you.
Okay, let's do the basics first. If I go on the LaTrobe Financial website, I can see they're offering a 12-month term account that's paying 6%, which is much higher than 4% I can get at CBA or the other big banks for a term deposit. Most listeners would know what a term deposit is, but that's not the same thing as a term account, is it? Which leads me to the bigger question. What is private credit, Johnny?
It's basically a loan of some sort that you have invested in. A fund manager or an organisation or an entity has given you access to a loan that they've written in. You're basically the provider of the debt into the economy. And it comes in many forms. There's corporate loans. You could lend money to a company.
Yep.
You could lend money to a property developer to build a block of apartments. Or in increasingly, and in the case of LaTrobe, you could lend it to LaTrobe so that LaTrobe could then lend it on to a borrower looking to get a mortgage on a home loan. So it's basically anything that isn't provided by the banks, which is the main source of investing in debt.
And private credit has ramped up in the last few years. What's been behind the boom?
Private credit at the moment, it's grown so much, probably accounts for 14% of all corporate loans in Australia, which is quite sizable. Financial market historians will sort of notice that it's been around for a long time. And even in Australia, we've had mortgage trusts and mortgage funds. We didn't call them private credit at the time, but they would certainly fit the definition of what we describe as private credit at the moment. The real ramp up in Australia probably occurred after the global financial crisis. Mm-hmm. The screws were really tightened on the banks to make sure they didn't take riskier companies, riskier property developments, and regulators just made it more onerous on banks to write those loans. So we had this huge financing gap that opened up because the demand for a residential property, for commercial property never changed. But the need for debt financing was the same. So what you had was a proliferation of opportunists. They saw a gap in the market. They thought, we can lend to developers, we can lend to companies that can't get access to debt from the banks, and we can charge them a high interest rate on that, and investors so that therefore can get a bit of a yield pickup, and borrowers, whether they're developers or companies, get the debt financing that they absolutely need to grow their business. So you had this sort of meeting of supply and demand, and that created a $200 billion growth in private credit in Australia.
So you guys have been writing about some of these big players, including LaTrobe Financial, which is a big marketer and a major sponsor of the Collingwood Football Club. Earlier this month, the corporate regulator really took aim at LaTrobe in particular. So what happened there, Primrose?
So LaTrobe has been operating since 1952. So it's been around a while and it's pretty high profile. And it was hit out of the blue with these stop orders on 3 of its main products, which overall hold assets worth $12 billion. Mm-hmm. And LaTrobe raises money from mum and dad investors, retirees, and through financial advisors, and they offer these residential property and commercial loans. And also, even more high profile, it recently listed a private credit fund on the ASIC, which again was pitched at retail investors. So it's a very popular product with retail investors, financial advisors, and retirees. And it was banned by ASIC from allowing investors to pour more money into these products, as the regulator said it wasn't targeting the right investors. Now, this is quite important because LaTrobe manages a total of $20 billion in funds and overall has about 120,000 investors. So it created a concern among all of these people. At the same time, it's really not great timing for LaTrobe and for its owner. It's been put up for sale by Brookfield with an asking price of around $1.2 billion. It was bought by Brookfield for about $1.5 billion. And as some listeners would know, the Canadian asset management giant has not been having the easiest time in Australia. It's had a major fail with its hospital operator Healthscope. So the sale now is quite high stakes for them.
So what was behind ASIC's intervention? What did they say?
Well, Fiona, ASIC has been warning for some time that they're going to do this big sweeping review of private credit. It's a sector that, as we said earlier, had blossomed sort of in the shadows and all of a sudden it was big and significant and raising a lot of money. So ASIC really had to get their skates on and get on top of things and find out where they needed to intervene and where they didn't. The interesting thing is that they sort of chose LaTrobe to make an example of, because LaTrobe are one of the better operators. There's a sweeping tail of cowboys operating in the private credit space. ASIC's issue with LaTrobe was that they did not feel the fund manager was properly articulating the risks of their funds as they outlined them in their target document. So the document said that it was appropriate for investors to put up to 50% of their investable assets into this fund. But ASIC felt that was a little too high because in these funds, you lock your money up for a year or 2 years and you might need that money. And they didn't feel that 50% was appropriate. It should have been something more like 25% or 10%.
Yeah, so ASIC has deemed it inappropriate for investors to place 50% of their portfolio into these accounts because of the risk of them. They're higher risk because of the type of mortgages that they're backed by. And some of these mortgages that are part of the assets under management aren't the sort of mortgages that banks would necessarily finance. Just over half of the mortgages in the 12-month account are rated as super prime or prime, but the other half are rated as below prime.
We heard a lot about subprime during the global financial crisis, so basically loans to people with riskier profiles. And in the movie The Big Short, I remember Margot Robbie had a memorable scene in a bubble bath explaining how mortgage bonds crashed the US housing market.
By the way, these risky mortgages are called subprime. So whenever you hear subprime, think shit.
So does this moment have a bit of a subprime feel to it, or is that unfair?
Yeah, so just putting aside LaTrobe for a second, when we're talking about private credit, this has been the worry that the pouring of money into private credit has echoes of the financial crisis. So in The Big Short, the American Securitization Conference in Las Vegas that they were making fun of in The Big Short.
5 years ago, securitization was a loser convention. 100, maybe 200 people would show.
Sorry.
$500 billion a year later, you get this.
There's a lot of smug-looking people in here. It's like someone hit a piñata filled with white people who suck at golf.
This year was like its biggest year. And we've also had some really big voices come out and say that it could become a problem. You know, JP Morgan's Jamie Dimon said that it could be a recipe for a financial crisis if it's mismanaged. The IMF has said also there's been a decline in borrowers' credit quality that hasn't yet filtered through to valuations. And if it's left unchecked, there could be systematic risks. So when our Chanticleer columnist James Thompson bailed up Joe Longo, the chair of ASIC, Longo really expressed the heart of his concern about private credit.
We love property in this country, yes, and the higher risk, the better.
And he said that 40 to 60% of the private credit sector is in property.
And not just any property, but a lot of it is development and construction. And we all know that's higher risk.
So he said, I think that the potential systematic consequences of that not being well managed are high.
Are high, yeah. Now, ASIC has made it absolutely clear.
Again, he hasn't said it is a systematic problem now. He's just talking about the need for action.
Fiona, from my 20-odd, which is sad to say, it's been so long, 20-odd years of covering Australian bonds, even during the GFC,
yeah.
The likes of LaTrobe have trained me or forced me or coerced me into not calling them subprime lenders and calling them instead non-conforming lenders.
Right.
And you know what, to be fair, I do have a lot of sympathy for that view too. We've seen a lot of the non-bank lenders like Pepper, First Mac, they do actually fulfill a quite important role in the mortgage market to lend money to households that they're good for the loan, but they don't qualify because they're a tradie, they run their own business. Even and sometimes you're an investment banker who earns a bonus and it's not predictable. So you do need these sorts of lenders. They fulfill a very important role in the economy. And they've proven over the years that they can manage losses. You know, they don't have a big, wave of defaults in their mortgage books. They're very good at what they do. Where this week did make people shudder and a little bit anxious in the wake of the LaTrobe issue was not that there was any issue with the LaTrobe funds, at least for the time being. For all intents and purposes, the money was backed by good assets and good loans. But there was a bit of a fear that ASIC's action might rattle the cages, and might make investors a little bit nervous or think twice about putting their money in a LaTrobe fund and potentially take it out and move it to a bank account or something like that. One particular fund in which you can take your money out on 2 days' notice, that had about $1.5 billion of assets, but only had cash of about $150 million. So there was a real possibility that if a high number of customers wanted their money, it could have created real acute pressure on that fund.
So in that climate of anxiety, the day after we started reporting on ASIC stop orders, we started getting peppered with messages from investors, and they were saying they couldn't access their accounts. And that was because LaTrobe took this extraordinary decision to shut down access to its entire online platform right after ASIC's intervention.
So, Johnny, Primrose, we've been talking about ASIC's crackdown on LaTrobe Financial. And in response, LaTrobe took what some say was an extreme measure and shut down its entire customer portal. Primrose, why did that spark so much concern?
Yeah, so it would be like Commonwealth Bank just shut down access to online banking for everybody just because 3 of its products were affected. So that understandably makes people nervous. At the same time, the firm reassured investors that they could still take out money over the phone, that they were adding people to their call centre, and that they were still processing redemptions as usual. But they didn't give much of an explanation, really, for shutting it down. And they basically said it was to comply with ASIC's orders. But we actually went to ASIC and we said, is this something that you asked for? And ASIC said, well, no, that was LaTrobe's decision. So it seemed like they were trying to actually slow redemptions or prevent a run.
And from my perspective, it's really hard to draw any other conclusion than the portal being down was a mechanism to introduce that bit of friction, slow the redemptions, and manage that huge potential risk.
So at the end of last week, ASIC's stop order was lifted and there hasn't been a run on LaTrobe funds, as far as we know. In relation to the broader private credit market, what is ASIC worried about, Johnny?
To put it bluntly, ASIC is worried that if this all goes pear-shaped and investors lose their money, everyone will point the finger at ASIC and say, you didn't warn us and you didn't do anything. as best they could, they wanted to get their heads around private credit. What are the risks? What are the issues? And they sent off two very experienced individuals, the former Chief Risk Officer of Commonwealth Bank, Nigel Williams, and Richard Timms, who used to work at the credit rating agency, Standard & Poor's, to go and just investigate and write a report on the private credit sector. And while the industry was sort of warning that, things are pretty good and we do things well, that report was pretty scathing, actually. Right. It found a bunch of practices that private credit funds do that most people would say it's just not cricket. Things like a lot of them lend money to themselves without disclosing things. They charge a whole lot of fees that they keep themselves and don't pass on to the investors. It's not quite clear how they value loans. When the loans go bad, it's not quite clear to the investor. So they found all these conflicts and they called it out in this paper. They didn't go as far as to say that these funds shouldn't do it, but they made the point that at the very least, the disclosure needed to be better, and investors needed more information about these private credit funds so that they could make an informed decision.
Yeah, and some of these loans have gone bad, which leads us to your reporting on the saga of Sydney businessman Jon Adgemis. It's a really interesting cautionary tale. He tapped private credit for $1.8 billion and faces a bankruptcy hearing tomorrow. Primrose, you've been covering what's been happening with Adgemis. Can you explain who he is and how he fits into the private credit story?
Yeah, so Adgemis was a pretty well-known banker in Sydney and deal maker for KPMG. And during his time at KPMG, when he wasn't swanning around Sydney and going to Rockpool, he made a lot of connections with people like Jan Cameron and Bruce Gordon and other billionaires. And after he quit KPMG, he wanted to become a property and hospitality mogul in the realm of Justin Hermes. And he was buying up property at a time when it was relatively cheap, actually, so around COVID and the pandemic. At first, he was borrowing from well-established institutions like banks, but as he progressed, he needed more and more money. And he was also trying to expand really rapidly. And he borrows more and more from the private credit market, including LaTrobe, actually. And as rates rose, which we all know affected the property industry, he gets in more and more trouble because he's trying to develop all these venues at the same time. He's trying to renovate them and run them. And some of these lenders were charging rates that are north of 12%.
Right.
Sometimes they're going up to like 20%. And then some of the loans, because he starts to default on them, they're subject to default interest. So that's even further up from 20%. And some of his properties had 3 mortgages on it or 2 caveats against them. So his story was a really, example of how easy it was to get these loans. And what we can see from the documents these private credit lenders were putting out to investors was that they weren't really disclosing his financial situation to the investors. And even worse, they were really misrepresenting it. They were saying it that, in some cases, they were saying he was worth, over $200 million, which was just completely not true. He was renting a place, his own house. So he wasn't really a top-tier borrower at all. And what's more, some of these lenders really didn't do their due diligence at all. And that included looking at the public record. And they could have seen that back in 2020, he was served a bankruptcy notice and sheriffs were actually sent to his house to try and recover assets. And this wasn't disclosed to some of these mum and dad investors who have now lost money because they invested in these private credit funds.
So you've got essentially retail investors and in particular superannuation money going somewhere that the banks won't go. Is that a good idea?
That really goes to the heart of some of ASIC's concerns here. Because on the one hand, we've got private credit playing this role of financing some of these businesses that are, developers that are making developments that we really need at the moment, or well-performing businesses that otherwise don't qualify for that kind of credit. So there are these sort of legitimate businesses and there's no problem with them. It's just that the banks have said, we're just not doing that kind of lending. But then you've got these cases like Jon Adgemis where you can ask, should his business be financed? And the answer is no. In fact, some of these private credit firms knew he wouldn't be able to pay the loans back, according to people that inside them that I've spoken to, but they just wanted to collect the high interest rate that he would have been subject to and then plan to get refinanced another 6 months later by another lender. And considering this person is not a reliable borrower or even a reliable business operator, what happens is then the collapse leaves many low-paid workers, small business and investors basically out of pocket. So without the curbs, it becomes predatory loan sharking.
But private credit does have a role. It certainly has a role in superannuation portfolios. One thing ASIC pointed out is that, some of the bigger funds invest quite safely in private credit and they've done quite well out of it. And there's no reason why individual Australians can't do well out of private credit. But the lure of those high interest rates and those attractive, yields has really attracted a whole lot of opportunists who we think have taken advantage of investors either through charging higher fees or to diverting money to where they want it to go, or there's conflicts and issues like that. So overall, this process has been painful for private credit funds. ASIC, whether it's gone too heavy-handed or not is an open debate, but what we're hoping is that ultimately standards will be lifted in private credit and that investors, whether they're super funds or even retail investors, ultimately have a lot more confidence and faith that if they make a private credit investment, they're afforded the transparency and protections. And if you believe in the efficiency of capital markets, then ultimately investors will trust private credit funds more. They'll ultimately get better, more sustainable financing, and ultimately it should be of benefit to all Australians. So we'll be able to deploy our superannuation money, get a good return, but also, help finance homes, help fund small businesses, and ultimately leave us all in a better place. So it's been painful, but I think we'll land up at a good place.
Thanks for coming on the podcast, Johnny and Primrose.
Thank you, Fiona.
Thanks, Fiona.
Thanks for listening to The Fin. I'm Fiona Buffini with senior reporters Jonathan Shapiro and Primrose Riordan. The Fin is produced by Alex Gow and Mandy Coolin. Our theme is by Alex Gow. If you like the show and want to hear more, follow us wherever you get your podcasts and consider rating and reviewing us as it helps others find us. For more stories about markets, business and power, subscribe to The Financial Review at afr.com/subscribe. See you next week.
The Australian Financial Review.